Hey friends, Ian here. I am back. I am here to speak today about dividend stock investing. I am here on our balcony in the beautiful Polynesian resort at Disney World in Orlando, Florida. So excited to be here today, and I want to cover the topic of tracking dividend income. I firmly believe in life that what we all can track can only improve. One of the things I love about dividend stock investing is I'm not worried about share prices. I'm not worried about aggregate portfolio value. What I'm worried about is the amount of passive income that I am earning through dividends, and I like to see that passive income over time, over each month, over each quarter, over each year, continue to improve. There's many ways that dividend income can continue to improve. It can improve when we all deploy more capital into the stock market. It can improve when dividends are reinvested. It can also improve when dividend stocks increase their dividends. That's why I love to invest in dividend stocks that have a track record, a history of increasing dividends over time. Now, I love this philosophy because I don't track my aggregate portfolio value too closely. I can't pay my bills with portfolio value. Moreover, that's just risky. That's placing a big bet, a big what if on the future of stock prices. But what I do track regularly are the passive income coming in from dividends. And I can see that that has increased over time. I share those stats, my percentage increases over time in my portfolio with my patrons. I'll link to that in the pinned comment below. But that's why I am such a fan of dividend stock investing, because I truly believe what we all can track can only improve over time. I want to share an analogy with all of you. I have been really focused on physical fitness, so has my wife. We have been attending F45, and we're just wrapping up right now a fitness challenge. This is our second F45 fitness challenge. Now, we've been in the program for longer than that in F45, and what I wanted to share with you that's so interesting is the 45-day challenge. Sure, over the course of 45 days, we've seen some improvements. I've seen some improvements, but 45 days, it's really hard to measure on that timeline because it's so short. But when I look at F45, they do something there called an in-body scan. It's a machine that you get on. It measures your weight, your body fat percentage, the amount of muscle mass that you have, and other metrics as well. When I look at the in-body scan over very long periods of time, it's interesting. I can see that since I started F45, I have gained 5 pounds of lean muscle mass. Now, I wanted to share that with you because it's so interesting what can happen when all of us track metrics over long periods of time. I didn't do just 1 or 2 in-body scans. I think I've done a bunch of them, maybe 5 of them in total since I started F45, and I've seen the chart go a little bit up, down, but when you look at the trends over long periods of time, that metric has only gone up and to the right. It has improved over time. So it's just like dividend stock investing. It's so important to track these metrics. And so the purpose of the video today, I've got my handy notebook, by the way. For all of you who remember those backyard blogging days, please put in the comments below. I'm so excited to be back filming videos outside here in Florida. Boy, what a great time of year. What a great state. It's so nice to be back to my backyard blogging days, but I guess the backyard today is the beautiful Magical Kingdom and Disney's Polynesian resort. But anyway, I'm gonna kind of scan down here and just look at my notes. One of the things I wanted to share today is dividends. I really believe they are for the people. They're for everyone. And so many investors, so many people in general, they worry about their finances. They worry about, hey, if I buy this stock or this index, this ETF, what if it goes down in value? In that case, the investor just loses money. That gets us nowhere. One of the reasons that dividends are for the people, in my opinion, goes back to what I said at the beginning of the video. I don't track aggregate portfolio value. It's nice. It makes me feel good. It makes me have a little bit more confidence, I guess, as the portfolio value increases. But what I really track are the dividends and the cash flow that continues to grow over time. Because my portfolio value, it can go down. But even when it's down, well, I get excited because I can buy stocks by cash flow at a discount, but it can go down, but my income can still be going up. That's what's so great, is the trend between dividend income and portfolio value. It's not necessarily always in the same direction. They can go in different directions over time, and that's why the metric I choose to focus on is dividend income. And I think that resonates with a lot of people, because the average everyday person, most people out there these days, they can't afford to worry about buying low, selling high, and portfolio value. It can get very stressful. Moreover, a lot of people, they can't take on a lot of risk. They can't take on huge risk. And I actually believe that the S&P 500 being so dominated by tech stocks, the top 10 stocks of the S&P 500 make up an enormous amount of the total S&P 500. And when you look at those top 10, it's mostly tech stocks. A lot of them don't pay a dividend at all. A lot of everyday people can't afford to place all of their eggs in that basket. That can be a really risky and volatile basket. One of the things that I love about dividends is they're for the people. They can provide an avenue to buy steady Eddie stocks that can be dependable, that can steadily grow dividends over time. They may not always keep up with the S&P 500, and with me, with my level of risk tolerance, that's just fine. I want to go through another story today. Back in the day, this is a really good story because it relates to Florida. One of my best friends from college, he was getting married in Florida. At the time, I was not only invited to the wedding, but I was invited to be a groomsman. And it was a time when my wife and I just got married. We had purchased our first condominium. It was a big expense for us. We just didn't have the money to attend. And at the time, I couldn't fathom visiting Florida. It was too expensive to visit Florida. We just didn't have the money. But what I'll say is, at that time, it was embarrassing. I was so embarrassed that I didn't even tell him kind of why I couldn't make it, because I didn't feel like, hey, I could be even honest at that point and be like, hey, I don't make enough money. I don't have enough money. I didn't have many dividends at that time. I had some, but we just didn't have the means to visit Florida. And so for many years, that was a friendship that kind of, I didn't speak to this person, and it was just kind of awkward and embarrassing. Finally, a few years ago, I kind of built up the confidence to reach out of the blue and explain the situation, and he totally got it. He's like, wow, back in those days, I didn't have much, money either. I was making a lot of kind of investments in himself and in his businesses, and we were just getting started out, and so he totally got it, and I kind of felt foolish, like, boy, I should have just told him this from the beginning. But that's how it was in those early days. And the reason I'm bringing this up is, in those early days, I couldn't afford to really place volatile stock market bets on a hope that stocks would just go up, but I realized that I could invest in solid dividend stocks like Johnson & Johnson and PepsiCo. Those are two of the dividend growth stocks that I started buying from the very beginning. And I could buy those, and I could see the stock price go up and down, and it was scary at times, sure, when it went down, especially when I was a newer investor. But I realized that those stocks, they met my level of risk tolerance, and my level of risk tolerance was lower because I was someone that back in those days, I couldn't afford to come to Florida. I couldn't afford the plane ticket, let alone the hotel cost, which was quite out of our league at any hotel anywhere near the wedding. And so that's just where I was, and I never want to forget that, because it's easy when we get some success, we get some traction, that we take on aggressive bets. I've made some of those aggressive bets. I share it all here on YouTube because this is a documentation of my journey. And some of you might remember, I'll link to it in the pinned comment below, I did a video about my angel investing. That wasn't really turned out very good. That was an example of getting a little bit of hubris after getting some success, and kind of letting the success go to my head, and then making subpar investment decisions that were just not aligned with my level of risk tolerance. And so I always want to remember, not only when I'm here in Florida, but when I'm not, those early days, and that we just didn't have that money, and we wanted to be more cautious with our investments in steady growth dividend stocks that are lower on the risk spectrum, like Johnson & Johnson and PepsiCo. And to this day, I need to remember that, because as an investor, I don't want to lose money. I don't want to take any unnecessary bets. I'm just going to double down and continue my strategy because it's worked. Look, we came here last year. We're here again. The snowball has built. It's taken a few decades. It's taken a lot of sacrifice. If I look back, I wish I sacrificed even more in the early days because that snowball could have been a lot bigger. When I look back, I wish I didn't make some mistakes like angel investing, but we all learn as we grow. And that's another point to all of you today that I wrote down before this video, and my wife was helping me too with some of these ideas. I'm so thankful that it's just this concept of don't give up, and that we're all human, and that even though dividends are measurable and we can measure our passive income growing over time, surely all dividend investors will make mistakes over time. We'll face setbacks. It's just like the F45 challenge. Sometimes in F45, when I look at my in-body scan, I've gone backwards, but I don't give up. I keep working, and that's how I've gained that 5 pounds of muscle over the long run. It's the same thing with dividends. I might have fallen behind. There might be times, I'll tell you, I shared this with my patrons recently, but there may be times when I don't have a lot of money to invest in dividend stocks. The best I can do is let it sit, reinvest some of my dividends, and wait until I have more disposable income to invest. That's okay. There may be times when I have to sell portions of the portfolio. I've done that. I shared that here on YouTube. Not so long ago, I had to take a pretty big haircut on the portfolio for a real estate investment that we were making. Now, I would say that that wasn't a bad thing because, you know, it's just a different type of investment. But I guess what I am saying is it happened. I had to sell dividend stocks, and it wasn't fun. It wasn't fun at all, and it set the dividend income backwards from dividend stocks, qualified dividend stocks. And so it's okay though, it's life. All of us are starting somewhere. Sometimes we have to restart our own journeys. We may stop for a year, have to start again. Sometimes it may take multiple decades. Some investors, it may take a lot longer because they might have dependents, like I do, like 2 kids and family of 4, my wife. We have a family to provide for. And some of us investors may have other extraneous situations. Maybe you have parents that you help out with. You have to help them financially. We all have our own story, but the key is not to give up and to look at the baby steps. Look at the baby steps of progress that can be made over time, and look at the big picture and zoom out. And so in conclusion, I just really wanted to share with all of you today a motivating message, some kind of true life stories from my own life that I've personally experienced. And hopefully this resonates with some of you out there in the community on YouTube. I hope you've enjoyed the video, and I just want to really emphasize that dividend stock investing, done right, done with the right dividend stocks, I believe is lower on the spectrum of risk with stocks like Johnson & Johnson and PepsiCo, and it's easily measurable. And I truly do believe what we can measure can only improve over time. And I believe dividends are for the people. If you enjoyed the video today, don't forget to subscribe to my YouTube channel. I am back, everyone. Welcome back, like Mace. I am so excited to be here. It has been a while. I know you've been waiting for the videos. I look forward to seeing you in the comments. I would really appreciate if you could click the like button. It means the world to me. Before I go, in terms of a full disclosure, I am long Johnson & Johnson, ticker JNJ, and also PepsiCo, ticker PEP. My kids are long Disney stock, DIS. Boy, that's a whole nother story, but what an experience here at Walt Disney World. Amazing place to be. Everything is impeccable. Just the level of attention to excellence in everything, all the way up from management all the way down to the custodian cleaning the restrooms here. The level of attention is impeccably perfect, and the branding is just on point as well, but that's a topic for a different day. Before I go, in terms of a friendly disclaimer, today's video obviously is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my personal journey. It's possible to lose money in the stock market, and so it's important to consult your licensed financial advisor first. I love you, everyone. Thank you so much for watching today. Aloha from Disney's Polynesian resort here in Orlando, Florida. And I'll see you in the next dividend stock investing video.